Hello and welcome to my next video in this series I'm calling Personal Finance 101. And today we're going to be talking about bank accounts. Why do you need them? How many do you need? Should you use debit cards or credit cards? And where should you put that emergency fund you've been saving up? So imagine you're living your life every day, you go to the grocery store and it's $100 for a small bag of items because of inflation and how crazy things are here in New Zealand. And then you wonder to yourself, wait, can I actually afford this? Don't I have rent due tomorrow? Or isn't my power bill going out tomorrow and I'm not sure how much that's going to be? So how do you solve that problem? How do you know that day to day you can afford the purchases you're making? And really the answer is it's hard to do that with one bank account. Especially if you have an emergency fund now. If you've got that in the same bank account that you're using for your everyday life, it becomes very hard to draw a line between that emergency money and the money you use for your everyday spending. And not only that, it's hard to know how much money do I need to leave in the account so that things like your rent, your mortgage, your power bill can come out and those things are paid for, and you can still afford the things of your daily life. And so the way to think about that is to actually have a bank account system. And so what I'd like to propose in this video is that you have at least 2 accounts, but I'd recommend 3 different accounts. The first one being a savings account where you're going to put at minimum that emergency fund. So the advantage of this is that you're putting it away, it's separate, and for you to draw down on that money, it's an intentional act of going there, pulling the money out, and transferring it to your other bank account for you to spend it. And so that just prevents you from automatically going into your emergency fund or your savings just by accident, just by your normal everyday life. And so in terms of choosing a savings account, your best bet is to go for an online only bank, and usually they're going to offer you the best interest rates with no strings attached, no withdrawal restrictions. You can take your money out at any time and you're going to earn a bit of interest, but the main point you want for this account, the main feature, is that it's just a separate account and that you can easily access that money when an emergency happens. Okay, so you've got that savings account, you've put your emergency fund in there, it's got a good interest rate and you can pull it out at any time and it's totally separate. The next question you might have is, how do you solve that problem? You're at the supermarket, you're about to buy your groceries and you're like, wait, can I actually afford this? Will I actually be able to pay everything else that's coming up? And really that's known as a cash flow problem. And to solve that cash flow problem, we can use bank accounts, these financial innovations, to help solve that problem. So the way you're going to do this is you're going to set up one more bank account and ask your bank for one more debit card. And so how this works is you need to separate your manual expenses, so those are your bills, your power, your rent, your mortgage, all those things that come out of your account automatically. And you want to separate that out from the expenses that you have on a day-to-day basis that you just spend using your card, in the stores, online, all of those kind of things. And so you're going to work out how much all those automatic expenses add up to, and then you're going to subtract that from your income, and then you're going to you're going to take whatever's left and you're going to automatically transfer that into this new account. And you're going to call that your spending allowance. And so that means that as you're going about your day, you're spending money, you're going into shops, you're doing whatever you need to do, basically you can spend with confidence knowing that even if you keep spending and you spend everything in that account and your card declines, you know that there's a separate account that will pay for all of your bills and all your automatic expenses. The other advantage of having the second debit card is the first debit card, your original card that you probably already have, you're going to be able to use that for things like online subscriptions. So you can keep those 2 types of spending separate. the automatic stuff that happens while you are sleeping or without you even knowing, and the things that you do in real time in person. And so for this system to work, you will need a bit of a buffer in each of those accounts. Specifically, you're going to need enough money in that first bills account where you get paid into to make sure that even in the scenario that you don't get paid for the month, you're going to be able to pay for all of your bills. And the reason for that is that if your bills all come out, let's say you get paid on the last day of the month, but your bills come out during the rest of the month. If you don't have enough money in your account at the start of the month and all your bills come out, you may be at risk of going into negative. So basically you want to have a floor of that central bills account. That means that no matter what, you can pay all of your bills for the month. So of course that requires you to know how much that's going to be. And so once you have these buffers set up, you have these cards set up, you can basically not think about your bank accounts. You can just go about your week, go about your month, do what you need to do, knowing that because you've separated these types of spending out, everything will happen automatically, and there will be a physical block for you to spend money that you really can't afford to spend. And so the final thing I just want to touch on is, what about credit cards? And so there are a few things about this. People think that by having a credit card it just makes this whole process easier. You don't need to have multiple bank accounts, you just got the money there, you can always spend, and you don't need those buffers, for example, and you may even get some points or benefits. The reality is that credit cards are designed to make you spend more money. That is what they are there to do. And they are designed for you to get into debt, to get you behind in payments, and for you to pay interest. Now, if you are one of the very, very few people that can pay your credit card off on time every single month and actually get some benefits from these cards, the reality is, and this is an ethical issue, is that those benefits you're getting are being funded by people that are paying extortionate interest rates. That's the only reason you're able to, on the credit card company's behalf or on the bank's behalf, go on holidays, pay for flights, all these kind of things. So for most people, you're not going to get any benefit. You're using a product that's designed, that's been engineered over years and years from an industry that just wants to make money off of you. And the final objection I've heard is that people want a credit card so they can build their credit score and so that they can buy a house or get better loans in the future. And the reality is that's just not how it works in New Zealand. I've actually been into a bank and told a bank manager, hey, this is why I want a credit card. And basically they laughed at me because they're like, that's not how it works in New Zealand. You don't need a good credit score to get a loan. They're a lot more holistic and they look at your income and all that kind of stuff. So that's really all I wanted to say for this video. I hope it's been helpful, and I'll see you in the next one.